Part 1. Most traders believe they lose money because they are wrong. They believe the market is punishing them for incorrect predictions, bad timing, or poor analysis, so they spend years trying to improve accuracy. They search for better indicators, better entries, better confirmations, and better signals. My own trading data showed me a very different truth. Most traders do not lose because they are wrong. They lose because they lack discipline. I saw it clearly when I reviewed my own history. Many trades were not bad ideas. They were badly executed ideas. I entered too early because I felt urgency. I exited too late because I felt attachment. I broke my own rules because emotion appeared at the exact moment. Discipline was required. For a long time, I believed the solution was prediction. If I could just be more accurate, everything would improve. But even when I was right, results were inconsistent. That contradiction forced me to look deeper. What actually changed my trading was not accuracy. It was discipline. And discipline is not willpower. Willpower collapses under pressure. When money is on the line, emotion always finds a way in. Real discipline is structure. It is designing a process that removes decisions from emotional moments. Instead of trying to control emotion, I stopped giving it influence. That is why my scanner does not give signals. Signals create urgency. Signals trigger fear of missing out. Signals invite emotional execution. My scanner gives boundaries. It tells me when trading is allowed and when it is not. It tells me when conditions exist and when they do not. That single change removed a large portion of my losing trades. Not because I became smarter, but because I stopped interfering. I stopped forcing decisions when clarity was missing. This was also when I learned the most important mindset my data ever taught me. Volume leads everything. Price does not move because of patterns or opinions. Price moves because money moves. Candles are the result, not the cause. When dominant volume is bullish, buyers are in control. When dominant volume is bearish, sellers are in control. That is not an opinion. That is participation. My job is not to argue with that control. My job is not to predict when it will change. My job is to respect it until the data proves otherwise. Every time I fought dominant volume, my results suffered. Every time I aligned with it, execution became calmer and more consistent. That was the moment trading stopped feeling random and started feeling structured. Part 2. As I continued reviewing my data, another truth became unavoidable. Discipline alone was not enough if my bias was wrong. That is when I learned a hard lesson. Bias must follow data, not confidence, not experience, not what I want the market to do. For a long time, I carried bias into the market. If I believed price should go up, I looked for reasons to buy. If I believed price should go down, I looked for reasons to sell. Even when I claimed to be objective, my bias shaped my decisions. My data exposed this clearly. Trades taken in alignment with data behaved differently than trades taken in alignment with belief. The difference was not subtle. It was structural. Bullish continuation is not a belief. It is a condition. It requires dominant volume. It requires structure alignment. It requires confirmation through behavior, not hope. When those conditions are present, bullish bias is justified. When they are absent, bullish bias is nothing more than optimism. And optimism is expensive in the market. Bearish defense is not fear. It is structure. It is the market showing that sellers are active and buyers are failing to regain control. It is visible through rejection, absorption, and failed continuation. This information does not come from emotion. It comes from observation. One of the hardest habits to break was holding bias after conditions disappeared. I would stay bullish even when volume weakened. I would stay bearish even when structure defended. Each time I did this, my data showed the same result. Losses increased and execution degraded. Letting bias go felt uncomfortable. It felt like losing control. But in reality, holding bias was the illusion of control. The moment I allowed bias to follow data instead of belief, trading became lighter. I stopped defending ideas. I stopped justifying entries. I stopped arguing with the market. When conditions disappeared, bias disappeared immediately. No attachment. No justification. No ego. This single shift removed a large number of losing trades from my history. Not because I became perfect, but because I became aligned. Alignment replaced prediction. Observation replaced opinion. And discipline finally had something solid to support it. At this point, my scanner stopped being a tool for finding trades. It became a filter for protecting capital. It showed me not just when to trade, but when not to trade. That is when patience stopped feeling like weakness. Waiting became measurable. Inaction became intentional. And that set the foundation for the final change my data forced me to accept. Part 3. Once bias truly followed data, something unexpected happened. Risk management stopped feeling forced. It became automatic. Before, risk management felt like a rule I had to remember, something I needed discipline to follow. But when probability and alignment became the focus, risk managed itself. High probability does not mean high risk. It means clarity. Clarity allows controlled exposure. Clarity defines invalidation. Clarity removes hesitation. I stopped increasing size because I felt confident. I stopped holding losers because I felt hopeful. Position size became a function of uncertainty, not emotion. Small size kept emotion contained. Defined loss removed panic. Repeatable logic removed hesitation. Before entering any trade, I already knew what would prove me wrong. Not what would make me money. What would invalidate the idea? That single change transformed how losses felt. Losses stopped being personal. They stopped feeling like failure. They became information. When invalidation is clear, there is nothing to panic about. The trade either respects structure and volume or it does not. If it does not, the exit is already defined. There is no debate, no bargaining, no emotional negotiation. Over time, trading stopped being exciting, and that was uncomfortable at first. No adrenaline, no urgency, no emotional swings tied to every candle. But that discomfort was actually stability. Consistency did not come from winning more trades. It came from losing correctly, from respecting invalidation, from accepting uncertainty. The market stopped feeling like an opponent. It became a system of conditions. I no longer try to be right. Being right is fragile. It creates attachment. I try to be aligned. Aligned with volume, so I respect control. Aligned with structure, so I respect memory. Aligned with probability, so I respect uncertainty. That is what my scanner represents. Not a signal machine. Not a shortcut. Not a prediction tool. It is a decision filter. It filters emotion. It filters impulse. It filters bias. It allows participation only when conditions exist, and patience when they do not. If you want to see how this discipline is applied using real scans, real markets, and real probability logic, subscribe and comment probability. Remember this: the market does not reward prediction. It rewards discipline. See you in the next video.